Hi, everyone. Thanks so much for joining us today. My name is Ashan Sandier. I'm the Chief Executive Officer here at Eagle Investors. And I'm happy to introduce you guys today a modern approach to retirement. Um, I have Samuel here today with me, and we have a lot to get through. Without further ado, I'd like to introduce the topics that we're going to get through today during this webinar. The first thing we're going to discuss is time horizon. One of the most important first things that one needs to do when evaluating retirement is how long that you'll be retiring till and your time horizon. The second thing is your risk tolerance and diversification. And the last thing is taxes and different kinds of retirement accounts. So we're going to discuss all of these things today and all of these different subpoints in depth so that you can gain a better understanding about retirement planning and the real modern approach to retirements that Eagle Investors is taking. So I'm going to pass it off to Samuel to talk about time horizon. Samuel, I know you have a lot in store for us today, so I'm happy to get started. We'll go ahead.
Definitely. Thanks, Sean. So I'm Samuel, Chief Risk Officer for Eagle Investors. And first, I want to start with why should I retire or why should I save now for retirement, no matter the age? And the real answer is the power of compound interest. As Albert Einstein said, compound interest is the eighth wonder of the world, and it simply works. So the idea of compound interest is the returns you're earning now will continue to earn more and more, not just on the principal, but the increase in accumulated interest from the previous deposits or returns. So whether you're just in college or you're 50 years old, if you don't have an established retirement account, it's never too early to start. And we can't stress that enough. But now we'll go into the differences in where you should be focused and exposure and risk tolerance. So I'll pass it off to Ashan for that.
Awesome. Thanks so much, Samuel. And I know there's a lot that we share in common here about risk tolerance and understanding, the different fundamentals of it. I'd like to share it with all the viewers today. Is the difference between growth and preservation of capital, and this is very closely related to time horizon. So, for example, the younger you are and the longer you have until retirement, usually directly correlates with the amount of risk one can take. And we'll get into more of the philosophy behind that and why that's the case. But if we go along with that assumption about risk, there's different kinds of assets, and we'll get into that on the difference between stocks and bonds and other alternatives. But obviously, between different assets, there's different risk and reward. Usually, equities or stocks are the highest risk and the highest reward compared to other retirement investments such as bonds. And what you find is that when you have a longer time to retirement, usually you can take more risk. Thus, individuals have more equity or more stock exposure. So here on the screen right here, you can see two different portfolios. The first one is on the left, and it's of a potential growth portfolio. This is one of my personal portfolios that we have here at Eagle Investors that we invest together, and we make sure that it's all properly allocated towards growth because we have such a long-term time horizon on it. This is something that we have a very long philosophy on, and we're planning to hold for many, many years, 30, 40 plus. So we're able to take more risk. Thus, you can see here on the left-hand screen, 65% is in domestic equity, 17.5% international equity. You have some in commodities or alternatives, as well as a hedge and some cash. So this is just an example of a portfolio, but this is showing you something that may be a little bit more growth focused, where is a little bit more of a risk on long-term approach. On the right side, you'll see a more conservative ETF portfolio. This is taken, this is a very classic approach here. You could even say this is like the classic 60-40 approach, which a lot of people have understood. But that's 60% in fixed income or bonds, which is known to be a lower risk, lower reward investment. And the reason we do this is lower risk is because when you're closer to retirement, 10, even 20 years, when it starts to get closer, is that you can't afford losing a large amount of capital and not being able to recover because you're going to have to pull the plug on those investments soon enough, or go into more liquid, or being able to spend more money and being focused on spending that money that you've saved. Then what you're going to have to do is have lower risk there with fixed income. So you'll see that there's still domestic equity and real estate and emerging market alternative exposure, but it's a lot less than what you see in the growth portfolio on the left. So what I want you to do is compare the preservation model versus the growth model and understand the true differences. And we'll get into a little bit more about that further down the
One
line. So then,
one thing to add
Emil,
on
go ahead.
the growth versus preservation is, like Sean mentioned, the reason for this difference is you have the time to recover from economic downtrends. So, for example, if you were retiring in 2010 and you were in all equities, or if you were retiring in 2009 and you were in all equities, you shouldn't be able to stomach a 50% drawdown in your whole portfolio, as you're going to need that money. But if you're retiring in 2050, 2060, or a little before then, you're able to hold through recessions, you're able to hold through drawdowns. As we know the expected historic return, and we can kind of project that forward, if we're looking at, we believe the United States economy will continue to grow. These alternative investments have a lot of promise as well. And we're able to stomach any types of drawdown to realize that expected return that we're kind of forecasting and predicting, as opposed to having to panic because we simply don't have the capital and didn't plan ahead. We want to avoid those mistakes now in the planning stages. So next we'll talk about the diversification and some alternatives as well.
Awesome. Yeah, Samuel, thanks so much for adding to that. And I totally agree with you. Next, I want to talk about the diversified exposure. And you guys saw that, within the portfolio, there's diversification between things like commodities and bonds and stocks. And there's many different investment products or investment instruments that are being utilized to make sure that risk is properly diversified. And why that's important, why is it important to diversify your risk? And I'm sure many people have heard about that. But don't put all your eggs in one basket is another way to say it. Is that if you put all your eggs in one basket, you put all your money on one bet, and that one bet fails, you have a lot higher risk, and you can lose a lot more money. So the probability of many different things failing compared to just one thing is that you're spreading out that risk, because just because one thing fails doesn't mean the entire portfolio fails. Is even multiple things in the portfolio can fail, and long-term things will be okay because we have so many different areas that the money is spread out across. So that's called diversification. That's just the fundamental explanation. And now I want to get on to the graphic on the screen here is the diversified exposure. So if you saw in the growth model on the left-hand side of the previous screen, you saw the diversification between domestic equities and international equities. This is something that we pride ourselves on at Eagle Investors, is being able to identify specific opportunities that might not just be in the domestic market, but also huge opportunities that lie in emerging markets and international markets. And so on the screen here, we have some different investments from all over the world that many retirement portfolios own. I'm not saying that this is stuff that everybody should own because of the risks associated with them. That's not the case whatsoever. But these are different opportunities and companies that you're able to own a share in, so you can diversify your money across the world. And we're able to do that in this day and age. It's the modern way of investing. So we have things like in Australia, we have Afterpay. It's a financial technology company. You have Infosys from India, Alibaba, e-commerce as well as technology from China. You have things like ETFs, which we mentioned in the previous slide, such as iShares, which can give you diversified exposure to different countries and even continents and subcontinents, such as Africa, which is actually pretty hard to invest in. The barriers of entry there can be a problem, which is another thing we can discuss in a later time. Also, Nestle up in Switzerland, I think that'll give you diversified exposure up to Europe. Also, Meli from South America / Latin America. It's like the Amazon of Latin America. That's what people have been coining it. I won't say, I need to do a little bit more research there, but it's definitely an emerging pick over there. You also have classic things such as in the domestic equity portfolio, which was the largest section, such as Goldman Sachs and Disney are just two names, in there that a lot of people will own. Samuel, do you have anything on, the different kinds of investment instruments, diversified exposure, and also, gold and the alternative? So what do you think on that?
Definitely. One thing I'd like to say is, I treat my retirement account very long-term horizon, and yet I treat it much more conservatively than many other portfolios. So I do look more toward those ETFs. Some individual names can be great as long as you're properly diversified as well and understand that and have sound investment thesis on each of those picks. But ETFs can give you great broad diversification and exposure to those different continents and groups. Typically, in the long run, one thing to note, and that's kind of counterintuitive, is value stocks actually outperform growth stocks, historically speaking, at least. And we also see that small cap companies outperform large cap. And this kind of makes sense as growth companies are inherently priced higher. There's like kind of premium that you see, as well as small cap companies have the potential to grow a lot more. And that's what we tend to see. In terms of I also like emerging markets and having at least 10% for myself in there in a retirement account with specific focus on Latin America emerging markets, simply because I love the commodity exposure that gains. Now, talking more on commodities, though, is the modern approach to retirement investing and how the 60/40 portfolio that Sean alluded to earlier is said to be dead. And whether that's true or not, only time will tell. But we have seen interest rates and the yields on many fixed income instruments completely flattened. And that's expected to stay flat for quite some time. Now, this doesn't mean if you're only a few years out from retirement, you should be putting all your money in equities because it's the only place to get a return, because you want to really tailor your portfolio toward your risk tolerance and not toward the return you need to sustain a living. You have to adjust that living expectations instead of adjusting your risk tolerance, because that's something you really don't have a lot of adjustments to make. So we can look toward alternatives. Some alternatives that I love: precious metals, gold and silver, and other commodities exposure as well.
Yeah, Samuel. And I know gold has been on a big bull run recently. And I know it's large investors have taken long positions there. Something about gold specifically and silver and precious metals is that there is a physical asset to it. To get into the philosophy side of things, I want to discuss, why is gold known as a safe investment, or why do people invest in gold? So this is actually very fundamental. Is if we go back in time, thousands of years, we realize that gold was used as a currency. And why was it used as a currency? Is because humans value it. It can be used in jewelry. It senses value because it's fun to look at and people enjoy it. And it's a commodity that has value. So what people go to gold for is a lot of the time is because it can offer that safety, because we have things like the US dollar, which have taken over the global currency that used to be things like gold. The US currency actually used to be backed by gold. So what people will do is if there's times of uncertainty where things like equities will go down, people could put their money, which could be in a safer investment, such as bonds are a safer investment, but also things that have been doing very well recently, such as gold. And there's things like inflation and understanding different kinds of risk. But it can be another way to really diversify your portfolio. And I'm glad Samuel hit on that
Yeah.
point. So
One thing to add on that gold talk, we could talk about gold all day. And there is some debate though. Like Warren Buffett won't really touch pure gold, as he sees it as something that doesn't give you anything. There's no returns, there's no company earnings. Now that said, there are a lot of reasons that it can be part of a portfolio, and there's a lot of reasons that institutional investors are building more portfolios with greater exposure to these precious metals and to gold specifically. And the thing is, it is a scarce element, and that means that these big institutions with lots of money behind them, the more that they increase their exposure from 1 or 2% to 5 to 10%, the higher the price of gold will go up. We've also seen a decline in the US dollar the past year from a lot of the monetary and fiscal policy that's gone on. And the decline in the dollar also increases the price of gold because it's quoted in US dollars. And we also see this in other commodities as well, how they are increasing and could continue to increase. We also have seen that real rates, which is you take interest rates, subtract inflation, are negative. So while gold returns nothing, holding your money in the bank returns less than nothing. So now, considering that, basically, gold can be holding alternatively to simply like cash or money in the bank. And as Sean mentioned, the inflationary hedge. And I'm also a huge fan of silver. as they're both precious metals, but silver also has the industrial input component. And the huge thing about that is there's going to be some metals in the next decade, basically, with the new like green revolution, investing in these EV and other tech and environmentally conscious technologies, basically. And these metals are going to continue to be needed on the industrial side, not just, inflationary hedging or gaining commodity exposure, but they're going to be needed and they're scarce. So things like silver, nickel, cobalt, palladium, these are also metals that you could look into, but you have to make sure you understand why and the thesis on those as well. But things like copper too, we've seen a monstrous run in 2020 on copper, and that's also more closely tied to how the economy is doing. But that's also another EV and environmentally uh, technology input metal that we see.
Yeah, Samuel. I totally agree, especially with the input, for example. I know solar panels, solar companies are using a lot of silver. And as you said, it's a limited resource. There's other limited resources such as oil, but the reason that they're scarce is because, there's only a limited amount on this earth. So one last thing I wanted to discuss was cash, which you did notice there was a small amount of cash, which was in the growth portfolio. So it's really up to the different investor, and it depends on the macro conditions, such as rates and real rates, such as Samuel just mentioned. However, we have to recognize that cash is also just a different instrument, similar to how stocks and bonds and gold and even real estate can be investments and instruments, that you can park your money. Cash is just another place that you can hold your net worth or your value in. So it's really a question of, diversifying and actually holding a bit of cash is true diversification. Is you're spreading your money out even further. So we have to think even like that. Um, I want to move on, Samuel, to the long philosophy and what we've been talking about. And it makes it go pretty basically is that what we're really doing here with the long philosophy, which is usually over 10 plus years, means that we're investing in the growth of humanity and almost the growth of innovation. And what that means is that although the market could crash tomorrow, and it could almost go to zero, right? We as a human race believe that eventually humans will continue to survive and innovate, and life will be better, and the economy will be better than it is at the current moment. And what we think is that the long philosophy is that if you hold over 10 plus years, usually it's 20, 30 years, like a retirement, is that your money will or the value will increase over time. It's not always very predictable, depends on when you're getting in the market, your timing, which is extremely important. We specialize that at Eagle Investors, that it's when you get in, but also how long you're going to be in, because and it's that trust in humanity. Samuel, what do you think on the long philosophy and the general thought process behind that?
Definitely, I'd stand behind that long philosophy. And if we didn't, we shouldn't be saving for retirement in the first place. And I don't think that's the way to go. One thing I want to add on the long philosophy is the idea of, well, when should I be putting my money in retirement? If the market goes down, should I be taking it out and putting it back in? And the answer to these would be just you want to buy these build up your diversified portfolio, and then you want to hold. And you want to hold through market down moves, basically drawdowns and everything, because like Sean mentioned, with the long vision, we see that we're going to expect the market to recover and go back up. One thing to add too is with cash, that can be an opportunity to basically get in at market bottoms, or when the market goes down, you shouldn't be looking to sell, rather buy. Buy when there's blood running in the streets. When everyone's selling, that means there's eventually going to be no sellers left, and that's going to be when the market comes back up. We saw that in March. That was a really, really quick, great example there. Everyone was selling. We saw a sharp down move, but then immediately just turned and went back up. Now imagine if you liquidated your entire retirement account. Not only would you solidify a minus 30 some percent loss, but you wouldn't experience the huge run that we saw in both the Nasdaq, the Dow Jones, as well as the S&P 500 and Russell.
Yeah, And most of the best investors in the world, what they stress these days is maintaining exposure for the long term. Is that if you don't have the reality of the situation is that we're going to miss out on moves in the market and in the world and opportunities to make money if we're not in there. So the whole goal is that the more exposure and the more investments that you have spread off across more things is the more opportunities that you're going to have to capitalize on growth and not miss moves. So the whole thing is, deploying your capital and not really looking to sell when it goes down. We have to have that opposite mentality of a new investor, like a retail trader. Is that when it goes down, everybody's selling, so I need to sell, and when it's going up, everybody's buying. It's pretty much the opposite. When it's going down, we're looking to buy, and we're getting the cheapest. It's a discount. I actually heard a quote is that the stock market is the only place that when things go on sale, people aren't buying it in excess. So when people, it goes down, it's a discount. It's like a discount on these assets. So why not get in? And that's another benefit of having cash.
One
So,
thing I want to add on that is, there's a time and a place to be able to try to time the market. At Eagle Investors, we have a lot of more short-term holdings and portfolios, and we try to take advantages of um, drawdowns or of the market going up in the short term and estimating those and predicting those. And we can do that with great success. But that said, it's we're taking more inherent risk by doing that. And as a result, when it comes to your retirement account, I think inherently there should be less risk taken, be more conservatively allocated, but also conservatively managed. So we want to, follow the idea of time in the market, not timing the market
yeah.
when it comes to retirement.
Yeah. And in terms of leverage and derivatives, when it comes to um, retirements and long-term things such as options and futures. I know one of the things is if you saw in the growth portfolio, you can have things like a hedge where your options, you can trade things like covered calls. You can also have different hedge positions, but usually we avoid heavy leverage, especially in retirement portfolios. For example, if you're going to have to be leveraging, you're likely taking some kind of loan if it's on margin for stock, and you're going to have to pay a fee for that loan. So we usually don't suggest that for retirements, and I
And one
personally
thing
don't do.
too, it would all be well and good that you could leverage up if you think the US is going to be great and the market's going to be great in 50 years, but leap leap options, long-term expiring options, they don't go out that long. So who knows where the market will be in 2 to 4 years, basically. Um, but like Sean mentioned, for hedging, it can be great, and that's what the institutions do. That's what derivatives were kind of made for. Now, retail as well as institutions took them and changed them to more speculative or capitalizing on volatility or other trends that are identified in the market. But primarily, they can be used for hedging a retirement portfolio if it's sizable enough, or you want to eliminate the tail risk, as that can be a big problem, and people don't necessarily like the volatility in their portfolio. So you can eliminate that with hedges, but also being properly diversified, you're inherently going to have less volatility.
Right. Yeah, Samuel. So I'm going to move on now to our last point here in the presentation, and that's on taxes and retirement accounts. So, Samuel, I know you have a lot of knowledge on this, so why don't you go ahead?
Yeah, definitely. So there's a few things to keep in mind when you either are adding to a retirement account or identifying what to go into. This graph here shows even at age 50, you can see various accounts, whether it's a 401k with catch-up contributions up to 24,000, or all the way down to just maxing out an IRA with $5,500 per year, and the expected returns, by the time you're 70. But between Roth IRA, Roth 401k, and traditional 401k, there's just a few differences that a lot of people might not know about, but are very, very important. So when it comes to Roth IRA and Roth 401k, those are the best, basically, in a sense that when are your funds contributed? They're contributed after your taxes are withheld. So you pay the tax on the money, but then it grows, and you don't have to pay tax when you pull your money out with all the returns. That's different than a traditional 401k, which will give you more benefits for when you actually put the money in, but it won't grow with those same benefits. Another thing about 401ks is, it's through an employer. So oftentimes you can take advantage of employee matching or employer contributions. So if your company that you might work for offers any kind of contribution matching plan, you should really take advantage of that, or else you're just leaving money on the table. As for Roth IRAs, I'm a big advocate of starting that as young as you possibly can and trying to max that out, as it's one of the best tax vehicles, especially if you're just a young student, maybe in college, you have a side job, save money, try to max out that Roth IRA every year. And the power of compound interest, as mentioned earlier, is really great, where you just save a little bit every year now. It becomes quite a bit in the future. And now, these can be really complicated. The tax structures and the Roth, I mean, not the Roth, but the traditional 401ks, as well as most definitely like individual accounts or more actively traded ones. So moving to the next slide, we have, we actually offer Eagle Investor Tax Services with Sam Hulse through his, he's a licensed CPA, and we offer that tax service for anyone that's looking to need help for tax consulting or with their tax prep, depending how involved they want to be with it and how much they want to learn it on their own versus having a professional do it who does it for his career. Sam's also a lead monitor at Eagle Investors, and he also has some great trades and everything else. So he's a really great guy to get to know and meet.
Yeah.
I'll hand it off to Sean to wrap things up, and anything else that I may have missed.
Yeah, thanks, Samuel. I think we covered a lot of great stuff in the meeting today. Really looking forward to putting out more of these videos. Just like Samuel said, I want to reiterate that Eagle Investors, we're all focused on, not just short term, but also long term. Education is our main suit. And that's why we put these things together for you guys. We have services like tax services to make sure that you're saving as much money as you can on things like capital gains, as well as planning well for retirement. And we have these services with our licensed CPA. So please go take a look at that. Also, we're currently offering a large discount on all private sessions. A lot of our different lead moderators and head traders offer private sessions with each other. And you can do it private. There's also maybe some group offerings, and there's things from bring your own agenda to options day trading, stock trading, retirement, and things like this as well. So without further ado, I just wanted to wrap it up and wanted to say thank you so much for watching. Make sure to join our Discord. The link is in the description. We'll also have a link to our tax services as well as the private sessions, which are on sale for the next few days. So make sure you check those out. Make sure to like and subscribe. Thanks so much for watching, guys, and we'll see you next week. Thanks.